South Korea is currently navigating an unprecedented financial phenomenon that feels less like standard, measured macroeconomic growth and more like a collective, high-stakes national gamble. This movement is being driven by a massive, highly coordinated army of individual day traders who are affectionately, and sometimes disparagingly, referred to as ants. While an individual ant lacks the power to shift the landscape, 14 million of them acting in perfect unison can fundamentally alter the economic trajectory of an entire developed nation. This collective force has pushed the country's benchmark index, the KOSPI, into an absolutely staggering and historic trajectory that is completely decoupled from traditional market expectations. Over the past year, this index has vastly outperformed traditional global heavyweights like the S&P 500 and the tech-heavy Nasdaq, which are usually seen as the gold standards for equity returns. In a matter of a single 12-month cycle, the KOSPI has effectively tripled in value, creating a hyper-bullish environment that looks less like a steady, healthy market climb and more like an outright psychological mania. The driving force here isn't the typical institutional money, foreign sovereign wealth funds, or conservative pension boards. It is ordinary, everyday citizens investing their personal savings, liquidating traditional assets, and, increasingly, borrowing staggering amounts of capital to chase the explosive, intoxicating highs of the global artificial intelligence boom. To truly decode why South Korea has become the absolute epicenter of this global financial euphoria, one must look closely at the architecture of the modern tech supply chain and how geopolitics intersects with corporate infrastructure. The massive wave of capital expenditure currently pouring out of Silicon Valley, with American tech titans pouring hundreds of billions of dollars into building out the physical infrastructure for artificial intelligence, has to land somewhere tangible. It turns out that a massive, disproportionate chunk of that global capital lands directly in the laps of two South Korean corporate giants, Samsung Electronics and SK Hynix. These two companies practically monopolize the world's supply of high-end memory chips, specifically high-bandwidth memory, which acts as the literal brain food and hardware foundation for advanced AI processors. Because US tech giants are spending at an unprecedented, almost reckless pace to construct massive data centers, South Korea has effectively become the ultimate proxy trade for global AI enthusiasm. When Wall Street decides to fund an AI revolution, Seoul reaps the immediate rewards. This dynamic has led to eye-watering stock surges where individual companies have seen their valuations jump by 500 to well over 1,000%, even overtaking traditional powerhouses like Taiwan's TSMC in terms of raw short-term growth momentum. This economic reality has completely transformed the social fabric and daily culture of South Korea, turning casual conversations in neighborhood cafes, subway cars, and late-night barbecue bars into intense, hyper-analytical debates over stock portfolios and market entry points. It is easy for outside observers to look at this behavior and dismiss it as pure, unadulterated greed or reckless speculation, but the underlying sociological reality is far more poignant and complex. For the younger generation of South Koreans, the traditional well-worn path to middle-class stability, which historically involves securing a coveted corporate job at a conglomerate, saving diligently for a decade, and buying an apartment in Seoul, has become functionally impossible due to skyrocketing real estate prices and stagnating wages. This systemic financial desperation has transformed the stock market from an optional wealth generation tool into an absolute survival mechanism. Popular financial influencers or finfluencers have risen to mainstream media stardom by perfectly capturing and validating this exact sentiment, framing the stock market not as a casino, but as the last remaining vehicle for ordinary citizens to escape generational stagnation and achieve genuine upward mobility. However, this widespread cultural desperation has birthed a deeply dangerous appetite for structural risk, characterized by a massive, unregulated surge in leveraged investing among people who cannot afford to lose. Many retail investors are not just buying shares. They are quietly supercharging their daily market exposure using complex financial instruments like leveraged ETFs, which are explicitly designed to double or triple daily market returns. While this aggressive strategy yields incredible, life-changing wealth when the market moves upward in a straight line, it acts as a swift financial guillotine the moment the market experiences even a minor correction. The level of secrecy and underlying shame surrounding this widespread leverage is incredibly telling. A significant number of these retail traders actively hide the true scale of their trading accounts and loan balances from their spouses, parents, and families, fully aware that they are walking a thin tightrope over a financial abyss. This systemic danger is amplified by the structural reality of the KOSPI itself, which behaves with the extreme volatility of a speculative penny stock precisely because Samsung Electronics and SK Hynix make up more than half of the entire index's total weight. If those two corporate pillars experience even a temporary slowdown, the entire national economy faces an immediate existential threat. On a political level, this speculative mania has not just been tolerated. It has been actively cheered on, institutionalized, and leveraged by political leadership looking to secure a massive voting bloc. By enacting sweeping regulatory reforms aimed at protecting minority shareholders, leveling the playing field against institutional short sellers, and structurally shifting public interest away from speculative housing and into liquid financial markets, the political establishment has explicitly tied its own survival to the daily performance of the stock exchange. This is an incredibly dangerous game of political chicken. If the market continues to thrive, it is viewed as a historic masterstroke of economic democratization. If it collapses, it will instantly wipe out the retirement funds, emergency savings, and borrowed capital of more than a quarter of the country's entire population, creating an unprecedented socio-economic disaster. The financial watchdogs in Seoul are already showing signs of deep internal anxiety and panic over this dynamic, openly expressing regret over allowing high-leverage products to be marketed so aggressively to retail traders who lack the institutional buffers to survive a sudden, sustained downturn. The fundamental structural flaw in this entire narrative is that the underlying global AI boom is showing early, unmistakable signs of friction and corporate fatigue. While the capital spending from big tech firms in the West continues to hit record-breaking nominal figures, independent global corporate surveys are starting to reveal a very sobering, uncomfortable truth. The actual cost savings, productivity gains, and monetization strategies resulting from AI integration are broadly falling short of the wild, hyperinflated projections initially promised to boardrooms and shareholders. If big tech executives realize that the actual return on investment for these multi-billion-dollar data centers is not materializing fast enough to justify the jaw-dropping expenditures, they will inevitably pull back on their capital budgets. The moment Silicon Valley decides to rationalize its spending and slow down its hardware procurement, South Korea will be the very first country to feel the whip, likely triggering an immediate, cascading collapse of the KOSPI and plunging the domestic economy into a severe, prolonged recession. Despite these glaring, well-documented warning signs, the market mania persists unabated because trying to accurately time the absolute peak of a global financial bubble is notoriously impossible. If the AI infrastructure spending spree continues at this hyper-accelerated rate for just another year or two, South Korean stocks could easily double or triple yet again, leaving anyone who chose to sit on the sidelines out of caution looking financially foolish and left behind. The market has already given these retail investors a brief, terrifying preview of its inherent fragility, with sudden geopolitical flare-ups causing swift, double-digit single-day drops that expose just how vulnerable the leveraged ants truly are to external shocks beyond their control. As a result of this looming volatility, some of the savvier early entry capital within the country is already quietly looking for exit ramps, looking toward alternative international markets like China to hedge their massive exposure. Ultimately, South Korea's army of retail investors remains locked in a high-stakes, breathless waiting game, fully aware that the AI infrastructure bubble cannot expand forever, but entirely unable to step away from the table while the immediate payoffs remain so profoundly intoxicating. To fully comprehend the scale of this phenomenon, one must look at the sheer numbers involved in this demographic shift. South Korea has a total population hovering around 51 million people, which means that with 14 million active retail accounts, nearly every single household in the country has a direct, unhedged financial stake in the daily fluctuations of the stock market. This is not an isolated subculture of tech-savvy youth or elite day traders. It is a cross-generational mass movement encompassing grandmothers liquidating traditional savings accounts, office workers trading on their smartphones during lunch breaks, and university students using their tuition loans to buy fractional shares of semiconductor manufacturers. The psychological normalization of high-risk investing has become so pervasive that choosing not to participate is often viewed as a form of financial self-sabotage. This collective mindset creates a powerful feedback loop. As more ordinary citizens pour money into the market, stock prices rise, which generates widespread media coverage, which in turn fuels an intense fear of missing out, drawing in the next wave of even more vulnerable, cash-strapped investors. This feedback loop is particularly dangerous because it masks the deep structural disconnect between the stock market's performance and the actual health of the domestic consumer economy. While the KOSPI index paints a picture of unparalleled national prosperity and economic dominance, the reality on the ground for small business owners, service workers, and non-tech industries is vastly different. The wealth being generated by this market rally is largely concentrated on paper and highly illiquid, tied up in volatile tech equities that could lose half their value in a matter of weeks if global macro conditions shift. Meanwhile, the massive amounts of capital being redirected into the stock market are being drained away from the local real economy. Money that would otherwise be spent on local retail, entertainment, services, and traditional small businesses is instead being locked away in semiconductor stocks or devoured by the high interest rates associated with leveraged trading accounts. This creates a fragile, top-heavy economic structure where the national wealth is entirely dependent on the continuous, uninterrupted flow of capital from a handful of American technology conglomerates. The role of social media and digital platforms in accelerating this mania cannot be overstated. Unlike previous historical market bubbles, such as the dot-com crash of the early 2000s or the housing bubble of 2008, the current South Korean stock phenomenon is hypercharged by algorithms that instantly distribute information, rumors, and trading strategies to millions of people simultaneously. Financial influencers operate with a level of trust and influence that traditional institutional analysts could only dream of, often using highly emotional, motivational rhetoric to encourage their followers to hold through market dips and double down on their positions. This digital tribalism creates a herd mentality where critical analysis is actively discouraged, and anyone expressing caution or pointing out structural risks is dismissed as a fearmonger or an outdated cynic who fails to understand the paradigm-shifting nature of artificial intelligence. This environment makes it incredibly difficult for individual investors to objectively assess their risk tolerance, leading many to take on levels of debt that would be considered financially suicidal under normal circumstances. As the global tech industry moves deeper into this cycle, the pressure on South Korea's chipmakers to maintain their technological edge is reaching a fever pitch. Samsung and SK Hynix are locked in a relentless, incredibly expensive arms race to develop the next generation of memory chips, requiring billions of dollars in continuous research, development, and capital investment just to maintain their market share. This means that even as these companies bring in record-breaking revenues, A massive portion of that cash must immediately be reinvested into highly specialized fabrication plants, leaving them highly exposed if the market demand suddenly shifts. If a competitor in Taiwan, the United States, or Japan manages to develop a more efficient, cost-effective memory architecture, the absolute dominance that South Korea currently enjoys could evaporate surprisingly quickly. The ants trading these stocks on their smartphones rarely account for this hyper-competitive corporate reality, operating under the dangerous assumption that South Korea's technological supremacy is permanent and unassailable. Ultimately, what is unfolding in South Korea is a profound and cautionary case study in what happens when national economic anxiety, generational despair, and a global technological hype cycle collide in the age of frictionless digital trading. The country's retail investors have shown incredible adaptability and collective power, effectively forcing the political and corporate establishment to cater to their interests in ways that would have been unthinkable a decade ago. But by betting the literal future of their society on the premise that global tech giants will continue to spend $500 billion a year on AI infrastructure indefinitely, they have placed themselves at the mercy of a corporate cycle they have absolutely no ability to control. When the music finally stops, and the global technology sector inevitably transitions from an infrastructure build-out phase to a cold, hard focus on monetization and profitability, the fallout will not just be felt in Silicon Valley boardrooms. It will reverberate through every coffee shop, household, and community across South Korea, serving as a stark reminder of the devastating human cost that occurs when an entire nation mistakes a speculative asset bubble for a sustainable economic future.